think we'll get underway. Welcome to the financing webinar. We're going to talk a little bit about interest rates and borrowing and how you get funding. So this is Michael Smith, and Mike and I met about a year ago or so. We had lunch in Phoenix.
Yep.
Yep. So yeah, I'd moved to Phoenix for a year. So Mike, you're just because you're in a suburb, right? You're in Greater Phoenix. I can't remember what part of Phoenix you're in.
Yeah, so there's like the greater Phoenix area, and then I'm in the Gilbert Chandler area, which is about 30
Yeah.
minutes from downtown Phoenix. So it's a
Yeah.
massive place, but yeah, technically the suburbs.
Yeah, it was nice of you to drive in downtown when we met for lunch because
Yeah.
it's 15 minutes to find parking. So
Yes, it did. Yeah, that was fun, and I remember it being pretty hot out too. So I'm
yeah, it
surprised
was.
you're an avid biker, I believe. So it
Yeah, I
was
like to
awesome.
cycle. Yeah,
Yeah.
I like to cycle. So how long have you been with Bank of America, and how long have you been in Phoenix for?
Yeah, so I guess some background on me. So I've been at Bank of America for now 8 years. I've been in this role as the regional sales manager of our medical and optometry division for the West Coast for almost 3 years. I've lived in Arizona my whole life, so I'm born and raised here. I love it here. I don't think I'll be moving. My wife is a veterinarian. She also practices in Scottsdale. And we want to raise our family here. And yeah, so I've been doing 8 years in practice lending, 3 years in my current role as the regional manager, and um, we I primarily focus on medical doctors and optometrists.
Great. Yeah. So anything else that you're financing into? Just so primarily your business is optometry and dentistry, or do you do chiropractor? Or what other verticals are you in?
So we have three divisions. We have the medical and optometry division, which is what I work in. We have our dental division and our veterinary division. And so we lend to anyone that's a licensed MD. There's a couple specialties that we don't currently lend to right now. Chiropractic is one of them. But for the most part, we cover almost every specialty, and we offer financing for essentially anything. So whether it be a startup, a purchase, expansion, real estate, all that good stuff.
Yeah. Nice.
Yep.
So I've been around a while longer than you, so to speak, in the business world, so to speak. And yeah, it's interesting to me that Bank of America, and I think B of A is the largest or second largest bank in America or the world, so to speak, but
Yeah,
you're
so
way
we
up.
are, Bank of America as a whole is the second largest bank in the US, fifth largest in the world. Our division, the practice financing division, is by far the largest. Last year, between all three of our divisions, we lent out over $2 billion specifically to doctors in private practice. So yeah, it's a massive division. We cover a lot of specialties, and a lot of doctors choose us because we are specialized. So we're going to be familiar with what practice financials should look like, what it takes to do a purchase or a startup, and just kind of make that process as easy as possible because there's going to be a lot on the doctor's plates. So we want to make sure to try to alleviate as much of that stress and burden as we can to kind of make the financing part as easy as possible.
Yeah, that's great. Because yeah, I'm just super happy, quite frankly, that the major banks, including yourself, or B of A, and especially B of A, are lending into the medical space. Because typically, because my point earlier was that usually bankers, for the most part, they're asset lenders. So you've got to have like real estate lending or commercial real estate lending, or even if you're lending into say manufacturing business, is typically there's some cash flow driven, but you usually want security over the
The
assets you're
asset.
lending against. Whereas
Yep.
in optometry and in other medical professions, it's purely a cash flow play, so to speak. So yeah, so tell me a little bit about why Bank B of A is lending into just a cash flow based business because that's fairly atypical in the banking industry.
Yeah, so I guess it started a long time ago. One of some of our founders basically decided that they wanted to specialize in. It actually started with dentists. So dentists was the original plan, and over the years it's kind of expanded into veterinary and medical. It is kind of asset based in the sense that a lot, especially in the dental side, there's a lot of really expensive equipment that we could use as collateral on the loan. But ultimately, it was just a decision that, one, medical doctors and dentists are pretty recession proof, so the business is
Mhm.
secured in that way. They're a necessity, and medical doctors do pretty well for themselves. So it's not the same as like if you're lending against a building like a residential or commercial building, in the sense that we don't really care. I mean, to an extent, your income matters, but more the asset itself matters. But there is some collateral, obviously, in optometry. There's the optical side and some equipment, but more so it's lending against the fact that this is a necessary business. Doctors do pretty well from themselves, and we have 20 plus years of history of seeing how successful these businesses are, and what kind of risk is involved with them.
Yeah, yeah, that's great. Yeah, because we found too, yeah, just with us doing business in the optometry or medical area, that like most doctors, I'd say 99% they function and operate in good faith. So they've got a license. So you're right. It's a there's a market demand that's more or less recession proof. It's not
Yep.
completely recession proof
Right.
because you've got
Yep.
the optical retail side, but there is some of that. But there is that ongoing. Patients need to go see their eye docs, and then yeah, so the risk is lower, I would think, in medical professions than it would be to say if I've got a retail store in the corner,
Yeah.
or there's a lot more risk there. So yeah, even with our business, we're never too worried that doctors aren't going to pay us because yeah, they function just very good group of people and they do well enough and operate in good faith. So I'm assuming that's similar in your space, and that's why Bank of America is deciding to lend into the medical profession or into
Yeah,
optometry.
I mean, so much so that we're one of the few major banks that offers financing for startups, let alone an optometry or medical practice startup. So, we've had 20 plus years of experience, and we have a lot of data to show, what the default rate is on these loans, how risky they are,
Mhm.
how secure the doctors feel when they open up, because there's a lot of anxiety, I'm sure, for doctors that are owning for the first time, whether they're going to be successful or how secure they feel. But I would say over the years, our default rate on our loans, and like I said, we did over $2 billion worth of loans last year, is less than 1%. So it's very,
Yeah, it's
very low.
wonderful.
Yeah. So,
Yeah.
obviously there's things that we can talk about that a little bit later, but there's things that we look at in order to qualify a doctor for a loan. Not everyone can qualify right away. But just the fact that, the business is what it is, and doctors in themselves are pretty successful. Very, very low default rate.
Yeah, yeah, that's great. Um, yeah, less than 1 in 100, which is great. So that's one of the things that we try to do at the Williams Group too, is that we're advocating for private practitioners to buy practices because I'm seeing more and more recently that the borrowers or younger doctors they come into school with a lot of debt. So fair enough. And then
Yeah.
they might get married, they've got their house debt, they might have some credit card debt, or they've got, a car loan, whatever. So there's just a lot of debt. Um, but so when I show them the numbers of what a practice can do in terms of how much cash flow can it generate, and then can it fund the loan? It's almost like a slam dunk as far as I'm concerned. Like it's a very extremely good investment. So I'm always encouraging young doctors. Let me show you the numbers. If you buy this practice and you borrow from Bank of America, and this is how much you can you can fund the debt and make a living. Because obviously the um, the young docs that are buying in is yeah they got to pay the bills. It's America. It's pretty expensive to live here, but the numbers work out really well. So yeah, and that's a good point too on the default rate because we see the same thing even with startup doctors that we're helping start up or practices. They very rarely fail. So there's a trade-off between other starting up or buying a practice, but it's almost the cap. I mean, you can speak to this too, but what we see is that, and Sheila's on too, and she works with a lot of startup doctors.
Yep.
Um, but the first couple of years, yeah, you're not making a lot of money, but ultimately, almost all the startups are successful. We see a few that aren't, but yeah, it's like 1%. So yeah, is that how you sort of see things too when you're analyzing the financial statements that for the most part, the sort of target practice that's being purchased. So if I want to buy a practice, that's the target practice more often than not, the numbers are going to work from a buyer's
Yeah, I
perspective.
mean, as a broad way of looking at it, yes, we kind of look at it. We always say it's like a marriage, right? So there's going to be a practice that maybe like the seller's only working part time, like three days a week. Maybe it's generating $400,000 to $500,000 of revenue. They're taking home 180, $200,000 of profit. That's a good practice. But if on the other side of the borrower, if they have significant debt, student loans, they have a large mortgage payment, they've financed a couple cars, that could be a little bit too much debt to work with that size practice. So it doesn't work all the time, but I would say in general, if you're debt averse and you're maybe fresh out of school, you haven't bought your house yet, then that could work. But ultimately, that's kind of what we do is we analyze, how much is the practice making, and I guess I can go into what debt service coverage means because that's kind of one of your questions I think we had. But
Yep.
basically, we call it your debt service coverage ratio, or in layman's terms, like your debt to income ratio. We say based on the practice that you're buying, and whatever number is calculated for your income. So if you own this business, how much would you make if you own this business? And we base that number off of historical tax returns of the practice and P&Ls to determine, the previous owner over the last couple of years has made this much. So whatever that number is that enough to support all of your personal debt? So is it enough to cover your student loan payment, your mortgage payment, your car payment, anything else that you have financed? Is it enough to cover your living expenses, depending on how big of a family you have, how many kids you have, or if you're married? Is it enough to cover your taxes, depending on the state that you live in? And is it enough to cover the business loan payment? So after all of that's paid, the debt to income ratio that we want to see is like a 1.2 or better. So for every dollar of debt that you have, both personal debt and business debt, we want the practice to be making you $1.20 in profit to cover that and still be above a break even. So if in simple terms, if you have $100,000 of debt yearly between your personal and the business loan, we want the practice to be making you $120,000 to cover that and still have enough of a buffer over break even.
Yeah.
So
So with the 120,000, so you're calling it 100 grand of debt. So then the coverage ratio needs to be um, say 1.2. So you need 120. Did you
yeah,
say 20% or
yes,
20?
120, 120.
20.
Yep, yep,
Right. But that again is after allocating all the necessary living expenses and whatnot.
yes.
So you're taking all that off, and what's left over after paying the rent or the mortgage or the personal expenses or personal loan, all that stuff. So
Yep.
then is the practice producing? You might have some other income sources, of course. You're taking that into consideration, like spousal income or whatever. But so then ultimately, yeah, if the debt's 100 grand, you want to be able to see that the income coming in is at least 120,000 a year. So then
Exactly.
you have
And that simple example, exactly. Yeah. So the 120 grand being all of your expenses, your living expenses, your taxes, and the loan payment. Yes. So basically, we calculate everything as conservatively as possible and say, okay, is this practice enough to support all that?
yeah, got it. Good. And you do take into consideration other income sources like a spouse's income, or yeah, talk about that a little bit.
Yeah. So the other income source we would consider is rental income. So if you have rental properties, residential rental properties, we'll consider income for that, assuming they're long-term rentals and not Airbnbs. And spousal income, we will consider if your spouse is on the loan with you. So if you are applying for the loan by yourself and you want to just buy the practice by yourself, then we would just include the practice's income to support your debt. If your spouse is on the loan with you as a guarantor, they don't necessarily have to be an owner of the practice. They could just be a guarantor on the loan, meaning When we look at your personal debt, it's combined where, if you have a mortgage payment, you guys are probably splitting that payment or whatever your debts are. If your spouse is on the loan with you, we can include their income that they have together with the practice profit to support all the debt instead of just the practice by itself. So we see a
Yeah.
lot of spousal guarantees on startups, because startups typically, as you mentioned, it's going to take a couple years to ramp up and build up that
Uh,
patient base and build up that revenue. So to get the numbers to work in our projections, usually you have to have your spouse income to sign on the loan to kind of make the numbers work.
yeah, good, good. Yeah, so you talked a little about the coverage ratio at 1.2 to 1, which is kind of a loan qualification idea.
Yeah.
So maybe talk a little bit more about what else is necessary to qualify for a loan, like FICO scores. We talked about the coverage ratio. Yeah, maybe just expand on the whole
Yeah.
qualification idea.
Yeah, so assuming the debt to income ratio looks good, so the practice is making enough money to service all the debt, that looks good. Other things that we look at outside of that to qualify you is going to be, potentially credit score. Typically, we want you to be above a 700, 680 to 700 is kind of the minimum. Usually, if you don't have anything major like a bankruptcy or short sale or late payments on your report, if you might have some late payments, we would just need to account for what happened. Maybe if it was auto debit got messed up or something. So credit score plays a part, not a huge part, but we definitely look at it. Your income as an associate. So, one, how long have you been licensed for? What is your income that you're making? Typically, the minimum that we want to see is about $100,000 or more is kind of the minimum income level. Obviously, there could be some cases where if you go on maternity leave or something, you might not have income that year, but that would kind of be the baseline. Time licensed, we would typically want to see at least 1 year licensed out of school. 2 years or more is great. Um, and then the last thing that we look at is your liquidity. So how much money do you have in savings that's liquid, that's not retirement, as an emergency fund? And basically, we calculate that in two ways. When it comes to a purchase, typically we want you at a minimum to have 7% of the loan amount in your liquid funds. So if you're looking for a $1 million loan to buy a practice, we ideally want you to have at least $70,000 in your liquid emergency funds accounts that's available to you. And we look at that as an emergency fund to not only cover your personal, but also cover the business. So 7% of the loan amount is kind of the guideline. The more, the better. And then when it comes to a startup, typically as a startup, because these are usually newer doctors, $25,000 minimum would be the minimum threshold for your emergency fund for a startup. And then again, obviously, the more, the better. The other caveat to that is when we look at credit card debt, personal credit card debt, we consider that negative liquidity. So let's say, for example, you have $30,000 in your checking and savings, but you have $10,000 in personal credit card debt. We would consider that as $20,000 net liquidity. So those numbers, the 7% or the 25,000 for a startup, would be considered net liquidity. So ideally, really minimal or low credit card debt would be kind of be the goal there.
Good. Yeah. So tell me if this is because I've tried to explain this to a couple of different people before, that same idea of having 7% or 10%, and to explain the rationale. So I'm assuming the rationale, tell me if I'm wrong on this. If I have no money whatsoever, not a nickel to my name, so to speak, I got all this credit card debt, say I've got 10,000 or 20,000 in cash, I got $20,000 in credit card debt. So effectively my liquidity is zero. Or if I
Yeah.
got 50 grand, but I got all this other debt. So I personally wouldn't want to loan to someone that didn't have any money whatsoever. So it kind of goes to the person's fiscal responsibility in a sense, that are they saving enough money personally? Because if they're doing that, okay, I'm willing to loan some money to that person, because it's not a small. It could be $1 million or half a million or 2 million or whatever. But yeah, you got to show that you've are at least conservative enough to have some cash in your own
Yeah.
pocket. So
Yeah. So
that's
there's a couple things with that. So one, yeah, to your point, it's kind of like, are you a spender or a saver? So that it's, it's not something that it's like a judgment call that we're going to make on you, but it's more of like you said, from a bank perspective and risk perspective, If you're lending out $1 million to two people, and one of those people had $0 in the bank, and another person had $100,000 in the bank, which one would you feel better about giving you your money back, right? So that's kind of a risk thing, but also there's a couple of events that have happened recently over the years that have also kind of made that more important. One, obviously, the most important being COVID, where COVID hit and all the practices had to shut down for 3 to 6 months. They want to make sure that you have that emergency fund to fall back on. So our loan is not at risk and the business is not at risk, because ultimately that's our main collateral that we take. So COVID was a big indicator, as well as recently United Healthcare got hit with a cyber attack recently, and accounts receivable were affected. So, some practices weren't able to get accounts receivable for a couple months. They eventually came in, but if you don't have accounts receivable coming in, how are you going to make payroll? How are you going to pay rent? That's another reason why you would have that emergency fund. So, I think personally, you probably would want something larger than that. If for $1 million business, you probably would want to have 1 or 200,000 in your emergency fund. But as at a bank, those are kind of the minimums that we like to see.
All right, so $25,000 minimum for startups, but then, yeah, so more conventional loans, it's minimum of 7% of whatever the loan amount is.
Yep, exactly.
Yeah.
Like a purchase or practice purchase or real estate purchase, or if you're expanding to another location, that would be the kind of the ideal would be at least 7%.
Would my would my 401k qualify for that as part of the emergency, or that's not, you don't count
We would
that?
want it to be liquid, meaning that you could take it out today without penalty. So a lot of times retirement accounts and 401ks and things like that, if you were to take it out before you're eligible to retire, there's a penalty. So we don't consider that liquid. We wouldn't want you to touch that. It would be anything outside of that. So checking account, savings account, investment brokerage account, something like crypto, typically not included in that.
May I
But
ask you
yeah,
that?
yeah, crypto is usually not included, but maybe we can get creative if that was where all your money was at.
Yeah, yeah, it's becoming a lot more stable, I must say, crypto, because I remember asking you in Phoenix if crypto counted, and you said no. And
Yeah, yeah,
who
crypto
knows,
right
maybe
now,
that's,
the bank, they don't see it as liquid, but I think it could change in the future.
yeah, yeah, it is liquid, but it's so volatile, you never know what's going
Right,
to happen. Tomorrow you might
exactly.
have half of it, so yeah, understood.
That's probably why they don't. Yeah.
So another thing I learned the other day, maybe you can comment on this, from a client, a mutual client of ours, actually, that was, so to borrow from B of A, um, the borrower needs to be, what, within, I think you said 60 miles or so of the practice location. So if I wanted to buy a practice up in, say, North Dakota, and and I want to do it, say, remote, um, optometry. So you're not going to fund that transaction. Like at present time, you've got to be within the proximity. So maybe just talk about that in terms of what the qualifying criteria is for buying a practice that's like not next door. And maybe also add on, go ahead and answer that, and I'll have a follow-up question.
Yeah, so typically the guideline is 60 miles, which in most areas that's, a 2 to 3 hour commute. We just have experienced over the years that anything past that, it could get to the point where the doctor just doesn't want to commute that long every day on a daily basis, 5 days a week, or
Oh, yeah, that
um, you
makes
know,
sense.
yeah, or they just, they end up wanting to move farther away, and it ends up being a lot longer than a 3 hour drive, and it just ends up being the point where we don't want the practice to be declining because of that, or immediately the doctor wants to sell the practice and try to get rid of the practice. So that's the guidelines, 60 miles or less. We'll literally just look at it on Google Maps and put in the two addresses to check. There could be some variance if it's like 62 or something. That's not usually a big issue. But to your point, when it comes across state lines and it's much longer than that, then that's where they have a little more difficulty getting on board with something like that. We typically don't do teledoc or anything remote. We would want the doctor to be able to get to the practice if something happened. If a doctor didn't show up or an associate didn't show up, they could go in and see patients easily. So that's typically the bank guideline is 60 miles or less.
Yeah. All right. And then what about, like if I own a practice already and then I want to buy another practice within that 60 miles, but my intention is not to go there. I'd like to buy the practice and then the existing doctors They want to stay, so they're going to see the patients. Will you fund into that scenario or no?
Yes, yeah. So when it comes to the point where you start to own multiple locations, we know that, obviously you can't be in every place at once. So we more just would want to understand the business plan. So whether it be you still continue to work 3 days in your main location with one admin day, and then you can go to the new location 1 day a week, or just whatever the business plan is, or kind of the if you're going to keep the seller on or the associates on, we would just want to understand that, and then also make sure that it's within reason of the distance between the two. If you're a doctor in Nevada and you're trying to buy a practice in Colorado or something, probably wouldn't work. But if it's in the same geographic region where you just want to get a different part of town, different demographic, then we see that all the time. Yeah.
Yeah. Yeah. All right. No, that's good to know. So one other thing that I learned when we met for lunch in Phoenix was the amount of funding that B of A will do relative to the gross revenue. So for instance, practice as a million, just use round numbers. They can do
Yep.
$1 million, and then I think you talk about your threshold on a $1 million gross practice. What are your limits and that sort of thing.
Yeah. So before that, so we actually don't do our own appraisals on the practices. That would be what you guys are for. We basically just accept and take what you guys, one, have agreed on purchase price. Two, whether you guys have come to an appraisal and what the fair market value is for that, we just accept what you guys have come to, and we lend based on what we're comfortable lending on. So we consider 75% of your practice's revenues as the equity that you have to lend against. So in that simple scenario, if the practice is doing $1 million in revenue, the maximum loan amount that we could give on that practice is 750,000. So similar to like your home, like your residential house, you know how they say loan to value, where you can do a cash out refinance on your house if the value is up to 70%. It's kind of similar to that. We just consider the value your revenues. So 100 the $1 million revenue practice, we can give you 75% of that as a maximum loan amount, and that would include working capital. So in that same scenario, if a doctor was buying a practice that was the purchase price was 700,000, whether that be the price that you guys have determined as fair market or the seller and the buyer have agreed to, we could fit in another $50,000 of working capital into that loan to do a total loan of 750.
Yeah, got it. Yeah, that was interesting for me to know that. So yeah, it was interesting that you sort of Bank of America sort of looks at a practice, so $1 million practice, the value or the equity of the practice, as far as you're concerned, tops out at 75% of the gross revenue. So
Yep.
that it's not far off in a sense from because we do a lot of valuations and you've got a few different components in the marketplace because
Yeah.
you've got private equity. I think there's basically three levels, so to speak, or three buyers. Private equity, and they're going to pay potentially 1.5 times revenue, ballpark. So $1 million practice, they'll fund up to 1.5 million, whereas corporates, so Essilor, Luxottica, BSP Ventures, et cetera, they come in more, they value it more one times revenue, so $1 million practice worth 1 million. But in a peer-to-peer situation, yeah, they're typically like 75% valuation or equity is on the kind of on the high end.
Yep.
Partially because, well, a bunch of different factors. One, if if um, if I buy a practice and I only have one of those practices, that's a lot riskier than say private equity that has 900. So yeah, if you got 900 practices, you can see one practice going down, so to speak, or failing. Whereas you got 899, your cash flow is still good. But if you own one, yeah, things aren't going right, then yeah, so it's a lot riskier if you own one practice. So that's one of the reasons why a peer-to-peer sale, so to speak, is yeah, it's almost capped by the banks in a sense because you're only going to loan up to 75%. And then even if I do want a 75% of that million, so $1 million practice worth at the max, if you want to get it financed 100% is 750,000. So a lot of practices that are under $1 million, yeah, they're going to value from an appraisal point of view, I'd say 60% or 65, and then because the number's going to work for the buyer, because like we talked
Yep.
about earlier with your coverage ratio, um, yeah, the buying doctor needs to be able to pay the mortgage, pay their student loans and all of that. So then you're not, the banks aren't going to loan into a situation where you don't have that proper coverage ratio.
Yep.
So if you value a practice at $1 million, say I'm a doctor, I own a practice, it's worth does a million, and I want you to buy it for $1 million. Yeah, you can't really make that work. It's very difficult because the debt service is just too high. So the banks, in a sense, for good reason, from a risk perspective, yeah, keep the value of practices down low. But
Yep.
that's one of the reasons why I think private equity has come into the market and say, look, because of the situation, yeah, there's an opportunity, so to speak, to consolidate practices and have a lot less risk because you get a bunch of them, and then they can pay higher multiples or higher amounts. But yeah, so it's an interesting market because there's quite a big variance between because we're talking to doctors all the time about what is the spread between potentially selling to private equity or selling to one of my associates, and there's such a big difference in potential. Um, Exit price or selling price for the owner doctors, it puts them in a difficult situation in a sense because you can have a family member or an associate you've been with for a while that's worked for you for a while, and then you'd like to transfer the practice to them, but then the money over here is so much greater.
Yeah.
It's hard to yeah. So there's a lot of issues in terms of valuations. But you guys you're going 75%. So if the practice already has, say, a bunch of leases or an SBA loan or some other financing. So let's just say go back to that example. $1 million practice. You're the most you're going to lend into it is 750,000, but the practice has already got $100,000 of debt. So yeah, maybe talk about that situation.
So yeah, so I guess there's two scenarios. So are you saying in that scenario the seller has $100,000 of debt? If that was the case, then essentially we would request payoffs and we require that debt to be paid off at closing. So instead of the seller getting a wire for 750,000, we would send a wire to pay off the $100,000 of debt, and then they would get 650,000 left over.
Got it.
In some cases, we could transfer debt over, but it's pretty unlikely. Usually, we just try to have a clean sale where the buyer that's buying the practice has no liens. All the liens are free and clear because all the debt is paid off, and the only lien that's put on the practice is with Bank of America. So we try to make it clean and simple, and usually the buyers are okay with that. And sometimes we could encourage like negotiating outside of the purchase, where maybe you um, increase the purchase price a little bit if you're going to take over some of the leases and just do that outside of the practice. But most of the time, it's just a clean payoff.
Yeah.
If it was a existing doctor that owned practices that wanted to buy another one, and we were kind of evaluating their debt, then yes, we would have that calculated into the ratio. So if they have $100,000 of existing debt on their current practice and they only had room for 650,000 left of their equity, then that would be our maximum amount based on what they have in current debt.
Yeah, good.
If that makes
Yeah,
sense.
there's a lot of different buying scenarios because you can buy a partial buy-in. So maybe I'll ask you about that
Yeah.
scenario. So you say, let's just say you got a doctor owns 100% and they want to sell 50% to their associate. Yeah, maybe talk about the partial buy-ins and how you structure those. Do you do those? And
Yeah.
yeah, just
Yeah,
talk
so
about
we do tons of buy-ins. We do them all the time. The only buy-ins that we typically don't do is like a minority buy-in, where if you were buying into a very large group and you were only going to get 1 or 2% ownership, typically those don't work just based on the way that we collateralize our loans and require like guarantees of the practice on the loan. But yeah, in that scenario, if you were wanting to buy into a practice as a 50% or 33% partner or 25% or whatever the case is, couple of things that we would do. First, I always try to have the conversation with the seller and just help them understand that the practice itself is going to be listed as a guarantor or collateral of the loan. So basically, what that means is we don't necessarily need to collect financials from the sellers and the other partners for this loan, but they would have to be okay signing on behalf of the practice saying that this practice and the practice as a whole is collateral for this buy-in loan. So if something were to happen where the buyer that was buying in defaulted on our loan, technically we could go in and sell the practice to try to make our money back or work out some type of payment plan with the practice to pay us off or maybe do another buy-in for another doctor, something like that. So first, I always like to have the seller on board with that. Usually it's fine because they're going to be getting a wire for several $100,000 for the buy-in, so they're pretty okay with that. But I like to cover that. And then yeah, so the way the structure would work is similar to debt to income ratio. Instead of looking at just the practice as a whole and saying, okay, how much is this practice making? We look at what is your ownership structure and what is your compensation structure. So we determine based on, the financials of the practice, how much are you going to make when you become owner of the practice? And that's based on the compensation that you guys agree on. So we don't require a certain compensation structure. You guys can work out whatever you decide. But I'll probably, and Brad, you could probably speak to this. The most common would be you guys just take the profits and split them 50-50, or you guys get paid a base salary and then split profits 50-50, or maybe your salary is based on your production levels. There's a bunch of different ways that you can do it. But whatever you guys agree on, we say we take that calculation and then we base it on the financials and say, okay, based on that, this is how much you're going to make. Let's just say it's 250,000. Is that enough to cover your personal debt, the business loan for the buy-in, all that other stuff that we talked about before? And if the answer is yes, then the debt to income in our eyes looks good.
Yeah. Yeah, that makes sense. So if it's my practice and then I want to sell the practice to one of my associates, and then I don't want to, so lots of those situations that we see is that the owning doctor will self-finance. But,
Okay.
but if they don't, then me as and if I want the associate to go get Bank of America financing, fair enough. You'll loan into that situation with your same coverage ratios and look at the contracts of how much is this doctor going to make after they buy in at 50% or 30 or whatever it is. And you're going to run the numbers, fair enough. But from my perspective, just thinking through that a little bit, I guess the reason why I would do it as a practice owner and let the whole practice be collateral is I know the cash flow of the practice. So, and I already know my associate, it could be associate or it could be a family member or whatever. I wouldn't do it unless I know them well enough that, okay, this person's got good character. Because after you work with an associate or family member, you know what their character is. You know if they're going to take the money and then just kind of, yeah, not have any savings and just live the life of whatever and just spend all the money. But yeah, so I'll have an idea. So I typically would, but I wouldn't do it if I knew my associate was out, living a life where they're just spending all their money and whatnot. And I say, no, not, yeah, you go, yeah, I'm not, yeah, I just wouldn't do it. But in most
Yeah, I mean,
cases,
well, think about it this way. As an owner, you're already giving up 50% of your baby, your business. Like they probably have had this business for 20 plus years. You've already got to the point where you feel comfortable giving up 50%. They probably have plans to give up the other 50% in a couple years down the line anyways. And you're probably only going to give that 50% ownership up to someone that you trust. Maybe, like you said, your associate or someone that that's going to work in the business, and you as a seller know that you're not going to fail as a business as a whole because you've been doing it for
yeah,
so long. And the reason why you would want a loan from a bank instead of seller financing is to get that one lump sum up front, because technically it is a little bit riskier to set up a 10-year seller finance payment with an associate. If something happens, you're going to have to go through a long line of legal work to even try to get that money back. And most of the time, it's not worth
mhm,
it. So it's a
yeah,
little bit risky to wait over 10 years. I know there's some tax benefits and stuff to doing seller financing, but I think in the long run, would you rather just have the 500,000 now or risk it over the next 10 years?
mhm, yeah, yeah. I always encourage sellers to get third-party financing and not self-finance. But yeah, there's worst cases where sometimes it does make some sense. So maybe I got to check the time here. Uh, Yeah, I think yeah, we haven't even covered half the stuff I wanted to ask you, but I think that's
We'll
all
have to
right.
do another
Uh,
series, part two.
Yeah, so I think we're going to the top of the hour. Is that right? I think so, but
You want to
um,
do some questions? Let's see if anyone has questions.
yeah, let's see. Because maybe I'll ask you one question first, because it's something I wanted to get to. And I think I'm kind of interested in. I think other people will be too. So if I'm going to, I want to get a loan to buy a practice or buy into a practice. Uh, how soon should I start that process? And you also mentioned that obviously I need to have at least, so if I know I'm going to buy a practice for that's $1 million practice, I know I'm going to pay roughly 700 grand for it. So so I need like $50,000 ish of
Savings.
yeah, of savings or just liquid capital of some sort. So obviously, if I, a lot of doctors wouldn't know that they would need that, but you're gonna presumably gonna tell them, like, we're not gonna fund you because you don't have enough cash. But yeah, so maybe just talk about what the timing, when, if I'm thinking about buying, say maybe I'm thinking about buying in a year, should I come to you now and get this going, or yeah, just talk about the timing of when I should come to you.
Yeah, so I'm always happy to have those conversations, whether it be you're ready to buy something now or 6 or 12 months down the road. I always try to kind of give an overview of the process and what it takes to qualify, and then we can talk through their financials to see, if they're ready now or what kind of things they need to do to get to that point, as well as, we potentially might need a household guarantor or something along that line. So we could have that conversation at any point. In terms of like processing and how long it takes to apply and get through the process. Typically, we can get a decision from underwriting, an official decision on approval or decline within 2 weeks after we have all the documents. So if you're like, there's this practice I really like. First, I want to see if I qualify. I'm ready to kind of submit an offer, but I don't really want to submit that yet until I know I can qualify. The broker, the seller is willing to send me their financials now. We can get a decision back on whether how it looks in about 2 weeks. And that, if you were approved, that approval lasts for 4 months at a time. So,
Well,
if you're ready to buy something in the summer, you're like, okay, I want to close by July. It's April now. Is it time to apply? Yes, you can apply now, and you wouldn't have to have that closed for the potentially the next 4 months. So that would give you a lot of time to, one, negotiate the price, figure out a closing date, kind of get all your ducks in the row because there's going to be a lot of stuff moving, like picking your attorney, picking your insurance company, talking to the landlord, getting the lease transferred over, all that stuff that happens in the purchase. So we try to give you enough time to do that. And if we even need to, if that 4 months isn't enough, we can always submit an extension and extend that time out. So if you just want a pre-qualification conversation of like, hey, here's a rough estimate of where I'm at, let me know what you think. We can definitely do that. If you want to actual go through the process to see if you actually qualify, about 2 weeks to get a decision back. So not too bad
yeah.
at all.
Okay, so I don't necessarily need to, if I think I want to buy either to the practice I'm working at now or maybe another practice, I can still talk to you and you can tell me, even though you don't have the numbers from the target
Yeah.
practice, so to speak, you can tell me, yeah, Brad, yeah, you could qualify potentially, or no chance. You've got to get some personal liquidity in place, or you need this and that. So it sounds to me like it would be good for someone who has the ambition to buy in 100% or buy in, that they should talk to you.
Yeah, I think at the high level, rough estimates of everything is ideal. So obviously you're going to know like what personal financials you have, but like, here's how much I think the purchase is going to be or the buy-in is going to cost. Here's some financials of the practice. Like I got rough estimates of here's the revenue, here's the profit. Then we can do that. Sometimes it's a little bit difficult if they don't know exactly what they're looking for. Like, someone might qualify for a $500,000 loan, but they might not qualify for 1 million. So that can be a little bit tough. But I could give rough estimates of like, here's the guidelines that we're looking for. And if they know roughly the loan amount they're going to need, we can do that.
Good. Yeah. No, that's really good. So yeah, maybe we should take a question or two. Maybe we'll just go for another 2 or 3 minutes, respectful of your time and Brittany's time and everyone's time here. So I think we've got a question. Let me see if I can see the whole question. Oh, here we go. Question is, appreciate it by the way. Let's say that I already have a practice. I got a practice, got it, and I'm looking to expand and purchase a new practice. What would you look for in order to approve a loan to purchase a practice for sale?
Okay, that's a good question. So a couple of things. First, Typically, when you have one location or a couple locations and you're wanting to do another loan, the bank that you're going to be working with, and a lot of the banks work similar to us, they're going to want collateral of all the practices. So they're going to want to put a lien against your main practice as well as the new practice because ultimately your total income is everything combined. So the first thing that I always ask is, do you have an existing loan with your current practice? Do you have a loan with another bank? Because potentially that can conflict with us doing a loan for you. So if the answer was yes, you're like, yes, I did a startup loan with X bank a couple of years ago. I have a loan with him still. We would either need to have that loan paid off and to remove their lien, or we could refinance it with us, which would mean we pay it off and then you would just do a new loan for that practice with us, and that would allow us to do a loan on the new practice for you. So that would be the first thing is making sure the lien situation made sense and it could work. The other would be we would evaluate both businesses. So we would see, what are the revenue trends every year? Is it increasing? Is it decreasing? Is it steady? How much are you making in your current practice? Does it make sense for you to do another one? Do you have the staffing or the business plan to handle both? And we would just kind of evaluate the debt to income ratio as a whole. So we would look at, obviously what you're making in your current practice. We can determine that based on your taxes, but also on the new practice, how much are you going to have to pay an associate to run the practice for you? How many days a week are you going to be working in there? How much is left over after that? And kind of factor that into the whole equation.
Good.
Does that
Yep.
make sense?
That's great. That's really good. Well, we didn't get to, I have several more questions on post qualifying and what happens after things are funded, but we don't have time for that today. So,
Okay.
well, hopefully,
Good.
Michael, we can do that. Hopefully we can do this again because it's informative for me and hopefully the folks on the webinar have learned something because I certainly did. Whenever I talk to you, I
Yeah.
learn something about finance. So
Awesome. Awesome.
interest
Yeah.
rates
We
have
should.
been flat for a while, for about a year, I think. I know the Fed rate, I know they meet 8 times per year, and then they've been pretty steady. So I don't. It's hard to predict where the rates are going to go, but they're higher, a little higher now than they were the last few years. But still, the way I kind of look at it is the returns on buying an optometry practice or buying into an optometry practice. Yeah, those returns. I look at the spread between what's the interest rate and what's the return you're getting on on the practice. And usually it's, yeah, to me, I typically think, yeah, this is like an easy decision. So yeah, I'm bullish on optometry practices in general and in healthcare. So
Yeah, I mean, I think it kind of follows the same suit as like the stock market or like buying a house, right? You can't really time the market perfectly. You never know what rates are going to do. If someone's telling you they know what rates are going to do, they're lying because nobody knows. We base our rates on the 10-year treasury, and the 10-year treasury is typically dictated by the economy and how people feel about the economy and what's happening around the world. And, no one predicted COVID, and that happened, and obviously, rates dropped like crazy, and whatever's happening in the world at that time could affect rates up or down. So
yeah,
I would say if there's a perfect opportunity that's there for you, and you probably can reiterate this, optometry practices can be hard to find depending on your location. But if the perfect opportunity presents itself, I would not wait for, the lowest rate that you think that you can get because you can always refinance later down the road.
yeah, great. So last question is how can people get a hold of you?
Yeah, so I believe on that the flyer that we had, there's my contact information, my cell phone, and email. If you guys could send that out after the call, that'd be great. But you guys can feel free to reach out via phone, call or text, or shoot me an email. We can schedule a call to discuss whatever your plans are. And I've worked with you guys for a year, several months now, and everything's been great. You guys are awesome. You guys do a great job on the
Appreciate it.
purchase side as well as Sheila on the startup side. So I'm happy to continue working with all you guys.
Yeah,
It's been awesome.
that's great. Yeah, thank you for your time, Michael. I appreciate it. And thank you to everyone that's attended and have a great weekend. Happy Friday. Thanks again,
Thanks,
Michael.
guys.
All right, bye.
Have a good day.